Holy smokers, folks. Can we just chill for a moment? Please. Oh my gosh, okay? It is incredible what I'm seeing out there. Everybody has to take everything to such dramatic angles in the market all the time. I don't know why this is. Is it to make themselves feel better? I don't understand. It's absolutely insane. Okay, there's a lot of things I want to talk about in this video, but first, I just need to vent for everybody out there to understand something very important and not get caught up into this, okay? So going into this year, into 2023, hope you enjoy this as always, by the way. Going into 2023, right? Everybody and their grandma's predicting this epic recession, right? Epic, oh my gosh, the stock market crash is going to get way worse. And despite many of the greatest companies in the world being down between 50% and 75% going into this year, it was still not enough for countless folks, right? They wanted them down another 20%, another 30%, another 40%, right? Get them down to zero, and then I'll buy it, right? That was the thought process. It's such an unrealistic perspective. Everybody needs like this dramatic insanity to happen right now, right? And that was Q4 of 2022, right? Getting ready to go into 2023. That was a thought process. Now, here we are, June 7th of 2023, right? And this is just what I've seen in the past few days out there, okay? I see somebody with a massive audience out there saying Palantir's the next Microsoft. As somebody that's a Palantir bull, can we chill for a moment, okay? We barely got to profitability on this guy, okay? Let's just chill before we start calling it the next Microsoft, okay? Please. This is why a lot of us retail folks are not taken serious, because we're out there making predictions on a company that just made it to profitability that's now the next freaking biggest company in the world. Chill, please, okay? I got to listen to Kathy Wood again out there saying Tesla's going to $3,000, right? And the robotaxi network's going to be this and that. I hope it is. But as a Tesla bull and somebody that's made life-changing money on the stock, let's chill for a moment, okay, before we get all excited about this stuff and say Tesla's about to go to $3,000 a share, okay? I had to listen to a guy on CNBC today, actually a pretty respected guy, say AI is bigger than the internet, right? Can we chill for just a moment? Like, come on, man. Can we let these things develop a little bit before we got to make these insanity predictions for shock value? Palantir's the next Microsoft. Tesla's going to $3,000 a share. It's going to be $10 trillion plus company. AI is going to be bigger than the entire internet. Like, can we just chill for a moment, folks? Please? Thank you, okay? Here's where you need to be in the stock market, okay? You've got one side, it's called the irrational emotional bears, okay? These are the folks at the end of 2022 that said it was going to get much worse and massive recession coming this year, and get ready, all the stocks are going to be down another 20, 30, 40, 50%, whatever, right? And the S&P 500 was going to 2,300 or whatever prediction they were making, and obviously the complete opposite of that has happened, right? Then over here, you got the irrational emotional bulls, right? That, everything's got to be the biggest thing ever, and it's going to be the biggest company ever, and the greatest thing ever, and everything is that, right? And these predictions, they come and go, and we'll see what sticks and what doesn't. Most of it doesn't stick, a few does, right? But you got that camp over there, okay? Then you got the middle ground, right? The middle ground, which is, you're not really bearish, you're not really bullish, just kind of neutral. This is where you need to be in the market, okay? You need to be right here, okay? In 2021, a lot of us got caught up into way too much of this side, right? And then in 2022, a lot of people got pulled way over here. So in a matter of a year, we went from just, obviously irrational emotional bullishness to irrational emotional bearishness, right? And I can tell you, just over the long term, this is where it pays to be. You don't want to be all the way over here. You're going to lose massive amounts of money. You're going to make some huge mistakes, okay? And ask anybody, including myself, that's ever gotten way too bullish out there, trust me, it doesn't end well, okay? And ask anybody that's an irrational emotional bear, and, well, you're not going to be able to find those folks because they're hidden in forums somewhere saying why everything's going to crash all the time, and they got no money, okay? And that's why they're always in those forums predicting doomsday, right? This is where you need to be, okay? You need to be a little more on the bullish side, but don't go over here, okay? Not everything has to be the biggest company in the world. Not everything has to be the biggest thing in the world, okay? We all need to chill a little bit, because when you start setting up things, that this is going to be, the biggest company ever, this is going to be the biggest thing ever, all you're setting yourself up for is for emotional damage, okay? Emotional failure is all you're setting yourself up for when that prediction doesn't quite work out. And guess what? That company doesn't become a $3 trillion market cap. And that company doesn't become a $10 trillion market cap. Let these things develop over time. Look out over the next 3 years. Over the next 3 years, you can see kind of what's happening. Over a 10-year span, you can see nothing. Absolutely nothing. It is impossible to predict how things will develop over the next 10 years. It is actually fairly, I don't want to say easy, but it's much closer to easy predicting the next several years for a company. Because you can look at what that company's doing, you can look at the products and the competitors out there of that service, and you can kind of make some educated guesses. And you're still not going to be perfect in this game, but you can make some educated guesses on what's going to happen over the next several years. Sometimes you're going to be right, sometimes you're going to be wrong. Damn it, it's a lot easier than predicting out the next 10 years, I can tell you that much. And this is going to be the biggest thing ever, right? And if we look at the public account, whenever I go to make investments, right, I'm of the understanding that most of my investments will work out. They will be successful. Some of them are going to be incredibly successful, way more successful than I thought going in, right? Good examples, Alpha. Good examples, Tesla. Way more successful. Some are going to fail. Some I will sell for losses. There's no such thing as batting 100% in this game. If you can bat 70% in the stock market, you're doing very well for yourself. Very well for yourself. If you can bat 80%, meaning 8 out of every 10 stocks you invest into go up over the next 3-5 years, you're doing great for yourself, okay? But I can promise you, you will sell for losses. You will sell for losses. You will make mistakes, and I promise you that, okay? And you don't want to get too high, and you don't want to get too low in this game. By making these absolutely insane predictions all the time of massive epic crashes and recessions, it's going to be the biggest crash ever, the worst recession ever, the worst this, the worst that, and this company's going to be the biggest company, and the biggest, and the biggest, and the biggest. I'm telling you, all you're setting yourself up for is emotional damage. You're not setting yourself up for money, okay? So let me get that off my chest. Let that sink into your brain a little bit. Watch it again if you need to watch it again. It's very important, okay? All right, let's move on, okay? Next thing I want to talk about, Campbell's flipping flapjack and soup. I know, we never talk about Campbell Soup on the channel, okay? Ticker symbol CPB, right? So this is one of those stocks, so Wall Streeters said, you need to be hiding your money out here, right? This is safety. This is what they told us, right? This is safety. This is a safety stock, right? This stock is down 19% this year. 19%. How is that safety? So I invest in this company, this Campbell Soup, to lose 19% in 6 months while everything else goes up and up and up? This is safety? I don't think that's safety, okay? What they say is safety, many times is not safety in the market. There's no such thing as safety in the market, okay? It doesn't exist. There's risk-reward profiles. Some have better risk-reward profiles than others. Some have really bad risk-reward profiles. And if you don't have much growth and you have things going bad for your business, you're set up for massive downside there. And this is in a year where the S&P 500 is doing very well. A stock like this, down 19+%, shouldn't be like that, right? If you look at a stock like Kraft Heinz, this is another one of those safety stocks, right? Is it really safety? It's down 41% in the past 5 years. Is a stock like that really safety in the end? This is what you got to ask yourself. Companies that have trouble growing their businesses, at the end of the day, are not safe companies. When I think of a safer company, I think of a company that can consistently grow their business over, a 3-5 year span and grow it every single year at a nice single-digit clip or even a double-digit clip, right? And is profitable, and they can grow that profitability over time. They got a good balance sheet, and they got products and services that are going to be much more in need 3 years out, 5 years out than they are today, okay? And that it's hard to duplicate those products. When you have, these companies that it's very easy to duplicate, it doesn't take a rocket scientist to make some soup. It doesn't take a rocket scientist to make some ketchup and mustard, right? And there's a lot of people, there's big markets, there's a lot of people that want to take business from that. And so these safety stocks, just keep in mind, many times, folks, they're not what they're all cracked up to be. They're actually not safety whatsoever, okay? Now, here goes another perfect example. Oh man, is this a good one? Damn it. I'm on my thing today, man. I am on my thing today. Woo-wee! Dollar stores, okay? People thought they would outsmart the market. They saw inflation going up so much. They said, oh man, look at inflation's going crazy. The consumer's going to be wrecked. I need to position into dollar stores because gosh, if the dollar stores or if consumers are hurt, then they're going to have to go shop at the dollar store. So Dollar Tree, Dollar General, all these stocks are going to do terrific in this high inflation environment because the consumer is going to have to trade down. And so these stocks are going to boom. I'm going to play calls on these stocks. I'm going to buy these stocks straight up. They're going to do tremendous, okay? And oh, wow, this is a past year for those stocks. How have they done in this high inflation environment that was supposed to be so good for their business model where the consumer got hurt and everybody's going to shop at dollar stores? Well, Dollar Tree's down only 18% in the past year. Dollar General is down only 33.6% in the past 1 year, okay? Don't try to outsmart the market with these little things. I know it's fun to think I can outsmart the market and time in and out of this, and I'm positioned into these stocks. All this inflation is going to cause everybody to go to dollar stores, and it's going to do so well. At the end of the day, folks, stay focused on the long term. If you like Dollar General and Dollar Tree for the long term, and you think their prospects are great for the long term, and you think you're getting at a great valuation, then fair play. Do what you got to do. The bottom line is I don't like companies that only have to compete on price. These are the sorts of companies that are only competing on price. It's in their flip and flapjack name. Dollar Tree, Dollar General. The only thing they're selling you is a price, okay? And trying to beat prices. That's what they're doing, right? This is why I try to avoid stocks like this like the plague. These type of stocks, Walmart. I haven't owned Walmart since probably 2010 or 2011, shortly after I got in the market. Because these companies, if all you have to compete off is price, how much value are you really bringing? How much value you really bring in if the only thing you have to compete on is price? Something very important. Think of the 10, 20, 30 biggest companies in the world in terms of market cap, right? Man, all those companies have a lot more to compete on than just price. Think about that for a moment. Think about Microsoft. Is Microsoft the cheapest product in the world? Not really, but their value proposition is unmatched in the marketplace. And look at their market cap. It's nearly, $3 trillion? Look at Apple, right? Is Apple the cheapest? Heck no. But dang, they have their value for their customer base. Folks like myself, Apple, right? You look at Meta, you look at Nvidia. Does Nvidia have the cheapest chips? Heck no. If anything, got the complete opposite, the most expensive chips. But they're delivering on something other than just price. Okay, and so if the only thing your business has to go off of is price, you're in trouble. That means you're not really able to provide great value out there. Okay, and that's something very important to keep in mind there. Okay, now you look at a stock like Intuit, right? And this is something else I'm seeing out there. A lot of people, I don't know, man. Maybe they learn a thing or two about the market and they think they can just make judgments off of stocks based upon one number or something like that, right? So you look at a stock like Intuit, right? And the stock's up 106% in the past 5 years. The PE ratio on it says 56. And so a lot of people just look at that and they're like, oh my gosh, that's an expensive stock for Intuit, right? Up 106%, 56 PE. Whoa, that's like triple what the market's at. Oh my gosh, so expensive. You got to do a little more digging than that, okay? You got to do a little more digging. First is, before we get into the numbers and trying to figure this out, think about their business model, right? Once you do a little study of Intuit's business model, QuickBooks and all the different products they have, some of the stickiest products you're going to find. And if you're a small business, you're going to likely continue to use their products for years and years and years to go because it is a pain to try to switch to something else that's probably going to be an inferior product, even if it's overpriced. Another perfect example of a business model that has something to compete off of other than price, right? So Intuit's business model is extremely sticky, so therefore it always should deserve and command a P ratio higher than the market. Because damn it, they got a business model that's far better than the average business model in the market. Intuit's got one of the best business models in the world, to be quite frank, okay? And so if you think about it from that context, all right. Now, should they command 56? Maybe not. But why don't we look out a little bit, okay? I always like to think about what's the company going to earn next year versus what the stock's trading at. So basically the forward P ratio, okay? And if we look at what this company's expected to earn in 24, right? Basically, the forward P right now is about 28 on the stock, right? I mean, for a business model like this, it's as sticky as this. I think a 25 to about a 33 is pretty fair. So I wouldn't call the stock expensive at all. I also wouldn't call it cheap. If it was trading under 25, then I would start calling it a cheap stock. But for right now, I wouldn't call it expensive. I wouldn't call it cheap. It's actually a fairly priced stock right now in Intuit. If you buy into it, you're probably going to do decent for yourself over the next 3-5 years. If the stock goes, another 20, 30% lower from here, you're going to likely do great for yourself over the next 3 to 5 years. I can tell you that, okay? So a little more goes into the stock market than just saying one number and certain stock price performance, therefore it's expensive. But a lot of people like to do that because they don't know how to judge anything further than that. Or there's a situation where, I mean, to be quite frank, they're just lazy. It's just laziness. They just want to see one number and say it's expensive or it's cheap, or it doesn't work like that. You need to do a little more digging. You got to look to the future a little bit and think about the business model and all sorts of things, okay? There's something interesting I saw out there today. Did you see a lot of these big dividend stocks today? You know, I know Nordstrom was up. Gosh, Nordstrom was up big today as well, which is another huge dividend stock. But Cake was up like 4%. Foot Locker up like 6%. Whirlpool up 6% today. You know, see something like this, something's going on here, okay? Now, Cake has a 3% plus dividend yield. Foot Locker has a 6% plus dividend yield. Whirlpool has a 5% dividend yield, okay? Something's going on when you see stocks like that making a move. Here's what I believe is personally going on, okay, in regards to this, okay? So, if you haven't seen and you haven't been keeping up, Truflation numbers have us going lower and lower and lower and lower. Okay, the next government numbers you're going to see, which is actually going to be pretty shortly here, likely within the next week, as far as CPI, you're likely going to see something with a 3, which is going to be extremely exciting because then we're only one number away from what the Fed wants to be at, which is in the 2s, okay? So that's what you're going to see, and then based upon Truflation, there's a high probability you're going to start seeing actually 2s this summer. 2s, okay? So if that's the situation, then it's very likely Fed funds rate's going to start dropping in Q4. You may say, well, why would they start dropping that? At the end of the day, it makes no sense to have a Fed funds rate 5% plus if you have 2% inflation. It doesn't make sense, especially if you keep coming in month after month after month with something in 2 in front of it. It doesn't make sense. And so when we know the Fed is much more quick to act when they have something to worry about, right? So let's say there's some bad economic number that comes out in Q3, Q4, whatever. The Fed can easily at that point in time start dropping rates, right? Once they start doing that and it becomes convinced, basically what's going to happen is treasuries are going to start basically falling, okay? What you're going to be able to get on T-bills is going to start falling and falling and falling, okay? And people are starting to, I think, catch on to this, in my personal opinion. And so what they're going to start doing more and more is positioning ahead of 2024. Because in 2024, a ton of these treasuries, and actually at the back half of this year, a ton of these treasuries are going to basically come due, right? And so, you know, basically they're going to expire, right? And folks are going to be able to take that money and buy more treasuries with it, or take it out and invest it somewhere else. And what I think is going to happen is as treasuries go down, dividend stocks get more interesting, right? Because they're yielding big numbers. And so right now, because treasuries have been yielding so high for basically about a year now, there's been really no appetite for dividend type stocks, because why would you buy, this is the way a lot of people view it, why would I buy a stock that has risk to get a 5% yield when I could buy a government treasury and get 5% yield? That's the thought process, right? So as soon as the market becomes convinced that rates are going to start dropping sooner rather than later, they're going to continue to position into a lot of these dividend stocks, which is going to make these dividend stocks run in likely the back half of this year and into 2024, as you get more and more folks that have all that treasury money saying, dang, what am I going to do? You know, what if your treasury is only yielding 3% at that point, and you can get a stock that's yielding 5 or 6%? Plus, if at that time you got more confidence in the market, that's another game changer out there, okay? So that's something to keep in mind there. Now, AI stocks, these stocks all fell big today, right? AMD 5% down, Palantir 5% down, Amazon 4% down. Anything in relation to AI fell pretty big today, right? This is a natural market occurrence. This is what you need to see. Okay, this is what you need to see out in the market. It's not natural for these stocks to go up every single day. You've got to have some pullbacks here. It actually makes for a much more healthy market. And it actually brings some of the bears off of the sidelines and into some of these stocks. And we know there's a lot of people that are way off sides in this market. We know that factually. That there's a ton of people that are way off sides in this market. They've been way too short puts. They've been not invested nearly heavy enough, and they've gotten just way behind market returns this year. And it's not even close. They're getting absolutely trashed by the markets, right? And so we know whenever you get any of these dips in some of these stocks, we know very shortly after they're going to be bought up. These dips will be bought up because there's a lot of sideline money. And remember, I just spoke about treasuries. As those treasuries, people get available to invest that money places, believe me, they've watched these stocks go up, and don't be surprised if it's a flood. As soon as these stocks drop for a few days, boom, next thing you know, it's bought right up, okay? Now, something the bears have been saying, right? The bears have been saying, I don't believe in this market until the indexes start doing well that haven't been doing well, and it's something more than just Nvidia, Meta, Tesla, and a few other stocks, right? It's happening. Yes, it is, okay? The Russell once again outperformed the NASDAQ substantially, and now this is several days that this has happened now at this point in time. The Russell is trashing the NASDAQ recently here, and I mean very recently here. And so now we're in a standpoint where also NASDAQ is underperforming the Russell quite substantially, which those bears were saying that, hey, I'm not getting off the sideline, I'm not changing my mind until, the Russell starts doing a lot better, right? Well, that's happening. So now it's going to be really interesting to hear what excuse the bears have next. Are they going to go with it and do what they said they were going to do, or are they going to make up some other excuse on why they're not going to buy right now and why they're going to remain short? That's what I can't wait to see this one. They're in a real pickle. They're in a real pickle. Because these folks have been so wrong. It is so wrong. And now the one thing that they said would get them off the sidelines happening. And now we're going to see, what are they going to do? Are they actually going to go in and start buying this market and go bullish? Or are they going to make up another excuse? My hunch is they're going to make up another excuse. That's all I'm going to say. I think they're going to make up another excuse. Well, this and that, and this is why I can't buy this market right now. But you got to understand, perma-bear mentality, they're never going to be able to buy the market. They're always going to be bearish. That's what you got to understand about these folks. They're always bearish. And you know how perma-bears are made. I don't know, some of you guys might have heard this story before. I don't know if you guys know how a perma-bear is made. Somebody that's always leaning very, very bearish, right? Perma-bears are made from a couple different ways. One is they got burnt in the market really bad, and so they just go negative on everything from there on out, okay? The second way a perma-bear is made is somebody that was a bullish person, and they sell out of all their stocks or a huge portion of their stocks, right? And they go short the market, or they just go to cash because they're convinced it's going to crash. Then what happens? Things don't go quite according to plan, and the market starts going up and up and up, and they're on the sideline not making money, getting very jaded by the day, saying, this is ridiculous. This market shouldn't be going up. These stocks shouldn't be going up. Thinking about, I just missed another $3,000 in gains, $5,000 in gains, $10,000 in gains, $100,000 in gains. And that's how a perma-bear is made. Nurture or nature, as they say, right? For the perma-bears, it's a little bit of both, okay? And believe me, you're not born a perma-bear. It happens because you got burnt in the market, or it's one of those two ways, actually. There's no other way of becoming a perma-bear. It's either you got burnt in the market or you sold out of stocks and you thought everything was going to go down and it didn't go down, okay? A few things to keep in mind here, folks, okay? GVD, growth, value, dividends. Build out your portfolios, growth stocks, value stocks, dividend stocks. A great combo of all three, okay? There's going to be certain times dividend stocks are doing horrible while your growth stocks are doing amazing, okay? There's going to be certain times when your growth stocks are doing horrible, but your dividend stocks are holding great, okay? Actually, these two are kind of switched in 2022 and 2023, right? A lot of dividend stocks did great last year. Great. And a lot of growth stocks did absolutely the worst, okay? And this year, it's actually opposite. Dividend stocks and value stocks are actually the deals. This is where the actual real arbitrage is made in the market right now, is buying these sorts of companies for the next few years. And growth stocks are trading much richer now at this point in time. Doesn't mean there's no opportunities out there, because there is. It's just there's more opportunities in these sorts of stocks now, right? Build out your portfolio, 10, 20 stocks. Don't get under-diversified in this game. That's how you make some huge mistakes. If you're only going 3 stocks, 5 stocks, believe me, I've been there plenty of times in the past, and man, when that one stock isn't quite working, it's devastating your portfolio, okay? Build out a great portfolio of 10, 20 stocks that you're proud of, right? Make sure they're companies with strong prospects, not just strong past, strong futures, okay? Strong balance sheets. Very, very important for these sorts of companies, folks. I appreciate you joining me as always. Thanks so much. Thanks for being subscribed. Woo-wee! That's a fun one, folks. By the way, I put together a couple workshops for you guys. They're absolutely free to access. That's going to be in the description area down there. Definitely check those out while those are still free workshops. One is if you make less than $100,000 a year. The other is if you make more than $100,000 a year, investing in this year and beyond. Some great little pointers and tips for you guys in there. It's absolutely free to access that. That is in the description area. Much love as always, and have a great day.